My parents bought their first house at 27. 3 bedrooms, small backyard, quiet street and a decent neighborhood. Nothing fancy, nothing special. Just a normal house for a normal young couple starting out. They paid $87,000 for it. That same house today, same street, same 3 bedrooms, same small backyard, is listed at $410,000. Their combined income when they bought it was roughly $48,000 a year. The house cost them less than 2 years of their salary. The median household income today is around $78,000. The median home price in America is pushing for $30,000. That's 5.5 years of gross income. Before taxes, same house, same concept. Completely different financial reality. And yet somehow the cultural expectation didn't update. Society still tells you that buying a home is what responsible adults do. That renting is throwing money away. That if you haven't bought a house by your early 30s, you're somehow falling behind on the invisible checklist of a properly lived life. But what if that checklist was written in a different world? A world that no longer exists? And what if chasing it in today's world isn't responsibility, but the single most financially destructive decision a young person can make? That's what we're getting into today. Let's be honest about where the homeownership dream actually came from. It wasn't always the universal expectation it is now. The idea that every middle-class family should own a detached single-family home with a yard and a 2-car garage is a remarkably recent cultural invention, one that was deliberately constructed after World War II through a specific combination of government policy, mortgage industry marketing, and suburban development economics. In the 1950s and 60s, it worked beautifully. Land was cheap. Construction was cheap. Mortgages were accessible. Wages were rising faster than home prices. A factory worker on a single income could genuinely afford a house within a few years of starting work. The math supported the dream. Then the variables changed, slowly at first, then dramatically. Land became scarce in desirable areas. Zoning laws restricted new construction. Institutional investors entered the housing market and bought properties at scale. Interest rates swung wildly. Wages stagnated relative to asset prices. The math stopped working around the 1990s in expensive markets. By 2010, it had broken in most major cities. By 2024, it had broken almost everywhere. But the cultural story didn't update with the math, and millions of people are currently making financial decisions based on a story that was written for a world that no longer exists, straining their budgets, delaying investments, accumulating stress all in pursuit of a milestone that the economy has quietly made inaccessible for a large percentage of the population it once served. Here's what actually happens when someone buys a home they can technically afford, but probably shouldn't. Meet Jordan, 29 years old, earns $71,000 a year, has been saving for 4 years and finally has $45,000 put together. She's been told her whole life that buying a home is the goal, so she starts looking. In her city, a modest starter home, and I use that term loosely because what passes for a starter home in 2025 would have been called a family home 20 years ago. Costs $385,000. She puts 10% down. That's $8,500. She keeps about $6,500 in savings because the down payment ate almost everything she had. Her mortgage at current rates lands around $2,400 a month. Add property taxes, homeowner's insurance, and the PMI she now pays because she didn't put 20% down. Her actual monthly housing cost is closer to $3,100. Her take-home pay after taxes is roughly $4,600 a month. She is spending 67% of her take-home income on housing alone. She has what, $1,500 left for? Everything else. Groceries, car, utilities, clothing, medical, emergencies, savings, investments, life. For the next several years, Jordan will be what financial planners quietly call house poor. Technically an owner, practically broke, unable to build any other financial position, because every spare dollar is absorbed by the asset that was supposed to make her wealthy. And the cruelest part? The home equity she's building in those early years is almost entirely theoretical. In the first decade of a 30-year mortgage, the vast majority of each payment goes to interest, not principal. After 5 years of $2,400 monthly mortgage payments, Jordan will have paid roughly $144,000 and reduced her actual loan balance by maybe $22,000. She paid $144,000 and owns $22,000 more of her house. The bank collected the rest as interest. The house had better appreciate significantly, just for her to break, even on the transaction costs. This is the starter home in 2025, not a launch pad. For many people, it's a financial trap with a really nice front door. Here's where the conventional wisdom completely falls apart. Renting is throwing money away. You've heard it 1,000 times. Maybe you've said it yourself. It's one of those phrases that gets repeated so often it starts feeling like a law of nature rather than an opinion. But let's test it against actual numbers. If Jordan rents a comparable apartment for $1,600 a month instead of buying, her housing cost is $1,500, cheaper per month than the ownership scenario. That's $18,000 a year. She is not spending on housing-related costs. Now, what happens if Jordan takes that $18,000 annually and invests it consistently in a broad market index fund instead of putting it into mortgage? Payments and maintenance costs. Over 10 years at historical average returns, that $18,000 per year grows to approximately $286,000. Meanwhile, the homeowner Jordan built maybe $80,000 to $100,000 in equity over that same decade after accounting for interest payments, maintenance, property taxes, and transaction costs, assuming the home appreciated at a normal rate. Renter Jordan, $286,000 in liquid, deployable investments. Homeowner Jordan, roughly $90,000 in illiquid home equity locked inside an asset she can't access without selling or borrowing against. The renter built more wealth, with more liquidity, with more flexibility, with significantly less stress. Throwing money away looks pretty different when you actually run the complete math. So why does the home ownership myth persist so stubbornly against the mathematical reality? 2 reasons, both deeply psychological. The first is what behavioral economists call the tangibility bias. Human beings assign significantly more emotional value to things they can physically touch, see, and stand inside. A house feels like wealth in a way that a brokerage account simply does not. You can walk through your equity. You can paint it, renovate it, show it to your parents. The psychological satisfaction of ownership is real, and it matters to people. An index fund sitting on an app screen, generating returns in the background, creates almost no emotional resonance by comparison. Even if it's worth more and growing faster, it doesn't feel like the same thing. And for most people, financial decisions are driven far more by feeling than by spreadsheets. The second reason is social accountability. Homeownership is public. Your neighbors can see your house. Your family comes to visit. Colleagues ask if you've bought yet. There is enormous social pressure attached to the homeownership milestone that has nothing to do with financial wisdom and everything to do with the deeply human need to be seen as successfully progressing through life's expected stages. Renting, by contrast, carries an invisible social stigma in many communities. It gets coded as temporary, transitional, a sign that you haven't quite made it yet. Even when the financial case for renting is overwhelming, the social case for buying can override it entirely. Understanding these psychological forces doesn't make them disappear, but it does make it possible to separate the financial decision from the emotional and social ones, and to make the choice deliberately rather than by default. None of this means you should never buy a home. It means you should buy one when the math genuinely works, not when the culture tells you it's time. 3 questions worth answering honestly before making any decision. First, does your housing cost as a percentage of income make mathematical sense? The general guideline is that total housing costs, mortgage, taxes, insurance, maintenance, should not exceed 28 to 30% of gross income. If the only homes available in your market push that number to 50% or 60%, the market is telling you something. Listen to it. Second, what is the true opportunity cost of your down payment? The money you put into a down payment is capital that stops working in any other capacity. Before committing it, calculate what that same amount would realistically grow to over 10 years in an invested position. That number is the real price of buying. Make sure the home purchase is worth paying it. Third, are you buying because the math works or because you feel like you should buy now? Be ruthlessly honest with this one. Feeling like you should own a home by a certain age is a cultural script. It is not a financial strategy, and the difference between those two things can cost hundreds of thousands of dollars over a lifetime. If you want to keep building this kind of financial clarity, the kind that helps you make major decisions based on real numbers, instead of inherited assumptions, subscribe to Real Veil Studios. Every video is built to give you a sharper, more honest picture of how money actually works. Subscribe and share this with someone who's been feeling pressure to buy before they're ready. Here is what I actually want you to hear. The starter home isn't dead because young people are irresponsible. It isn't dead because this generation drinks too much coffee or spends too much on streaming services. It's dead because a specific set of economic conditions that made it accessible for previous generations no longer exists. And that is not a personal failure. It is a structural reality. But here's what hasn't changed. The goal was never really the house. The goal was security. Options. The feeling that you had built something real, something that belonged to you and couldn't be taken away by a bad month or an unexpected bill. That feeling is still available. It just doesn't have to arrive through a 30-year mortgage on a property you can barely afford in a market that has moved well past the point of accessibility for most people. It can arrive through an investment portfolio that grows quietly while you sleep, through financial flexibility that lets you move, pivot, and choose without being anchored to an asset you can't easily exit, through a net worth built on things that are actually working rather than things that look impressive from the street. Your parents' path was built for your parents' world. You live in a different world, one that requires a different map. The good news is the destination: genuine financial security, real freedom, a life built on options rather than obligations. That part hasn't changed at all. You just need a different route to get there.